Well, okay. Another week over, and we are now 3 days away from the next FOMC meeting, and we'll handicap the expected increase and see what the probabilities are. Have a look at the top up here. This is I try to put across the top the year-to-date highs. Look how many of them last week hit their highs for the year, which was Thursday. Only the 7-year and the 10-year are sitting with June 14th as the high yield of the year. And the 7-year got to 3.59 on the 15th, 1 basis point below 3.6 before ending at 3.56. 4 more basis points and you take out this high yield. For the 10-year, we are 4 basis points below the high of the year. So depending on what happens in front of the FOMC and what their rate move is, we might see new high yields on the 7 and the 10-year for the year. All of them increased during the week. We can see this line in here, the change, all green, all of them increased. Most of them year-to-date highs. The yield curve, look at this. Look at these big moves. Back down to negative 40. Last week it was negative 23, so negative 40 on the 2s to 10s. That makes 73 days now that this key spread has been inverted. The 2 to the 10 is more of the key spread. There are more spreads. You have 5 to 10, the 2 to the 20, the 10 to the 30, and then you have the spreads with the short term, with the 3-month, the 3-month to 5-year, 3-month to 10-year. This is more important for the banking and insurance industries. Looking at these. We'll look at a chart shortly, which looks at a bunch of curves across a number of countries, because I've been asked if I could provide that. And look, I don't really have a lot of skill set in some countries. Some countries I know nothing about, but I have found a service that allows me to have all of that information at the same time, so we can just look at what that chart provides us. Fed balance sheet week ending September 14th increased by 5.5 billion. Increased. This is mostly in mortgage-backed securities. T-bills ran off by about 4 billion, but MBS increased by about 9 billion. But this is stuff they had already agreed to back before they started the balance sheet runoff. I think this was the last settlement month for MBS. I don't think there's anything more. So from here on in, it should be clean. So the total of the balance sheet is 8.307 trillion. Treasury September 15th, 9.8 billion will run off. This is as of September 14th, which was the Wednesday. So on the Thursday, 9.8 billion would have ran off the balance sheet. So as of now, that's pretty much gone. And September 30th, you have 33.8 billion in treasuries maturing, and that will run off as well. So I think from here onwards, we should just see decreases in the balance sheet, except for the tips. The tips would have increasing principal. So on every coupon date, the principal would reset to whatever the inflation, whatever inflation was over that period of time, because the next coupon is based on that higher principal. So for rate hikes, last week we had 9% chance of 50 basis points. Pretty much the entire weight was on 75 basis points. So it wasn't fully priced in. Well, now it is. We have an 82% probability of 75 and 18% probability of 100. So 75 is basically in the cards. I can't see the Fed going 50 at this point, knowing that it would just cause a rally in the market, a rally in yields, and it would loosen financial conditions. So 50's off the table. We can say that. 75 is the baseline. There will be discussion of 100 because it is partly priced in. So if they go 75, well, the market has priced in 18% probability of 100. You will get a rally as this comes out of the expectation. That'll come out. So if you go 100, because it's only 18% priced in, you will get a sell-off and a tightening of financial conditions. And if their goal is to get to 4 to 4.5% by the end of the year, what's wrong with front-end loading it? You could put 100 in and you can kill two birds with one stone, which is to accelerate the rate hike to work against inflation and to push back on a market that just seems absolutely unwilling to accept the Fed at its word. So, 75 I think is a fundamental move. Maybe the other 25 for a psychological move might make 100. I think they know full well that if they go 100, being that it's only 18% priced in, the market will have to catch up to that, so there will be a sell-off that day. I don't know. I don't know what to do. If it were me, I think I would have a very tough decision. 75, I think, is an outsized move. It's a third one in a row. We've made our point already. The market is expecting the 75. We can see from the terminal rate at the end of the year what they have for the end of year terminal rate. The 3.5 is gone. The 3.75 is gone. The 4 on the low end, 4.75 on the high end. If I went 75, would that reignite the narrative that I'm going to pivot? Maybe if I go 100, I really once and for all settle it, but I still have a job to do and I still have an economy to take care of. Is 100 just to send a message? Am I willing to do that much damage? I don't know. I think this is going to be a tough decision. I think the minutes when they do come out 3 weeks from Wednesday, I think that is going to be an excellent read. But for now, I don't know. I see 75 for sure, and I think I would accept these odds. Maybe you got a 20% chance of 100 on this one, maybe just 20. If you do get 75, watch the Fed Watch tool the day before going into the meeting and look at the weight of the probability here. If this drifts the weight to 0 and you get 75, well, the market has fully anticipated it, and I don't see that on its own could be a rally or a sell-off. But if this weight gets higher and higher and higher and they go 75, you will get a rally, because this has to come out of the market. You will get a rally on that one. 4.75 now on the high end to end the year. I don't see that. I think that's a little bit too aggressive. I think here 425 to 450 I think is the right ending point based on what we know now. I mean, things change, right? New information comes out all the time, so you can't just say that's what it's going to be. All you can say is, from where I stand today and my experience with this kind of stuff going forward, that seems reasonable from where I stand today, but something may happen over the next week where you go, okay, well, that was unreasonable now. Maybe it's too high, maybe it's too low. That's called Bayesian updating. You have to be able to absorb new information and say, well, the decision I made yesterday was based on everything I knew yesterday. I know more today, so now I can update my decision. I don't need to anchor to that and say, oh, I need all the data to work out so I don't look wrong. Let's look at spreads, and we'll also look at spreads in different parts of the world here shortly as well. They all contracted. I am, I find that curious. Even triple C, sorry, this should be green. Triple C increased. That should be green. But all the rest have contracted. And I don't know that we can say that we've bottomed out in the market until we see spreads increase to represent recession risk. I'm not seeing that happening. For the last 2 weeks, these spreads have contracted. Interesting. Well, let's look at some yield curves across different countries. In the chart, I have the U.S., the slope of the 10-year and the 2-year here from the beginning of the year. So you can see it pretty much come down all through the year. If we go a little bit longer, let's say 5 years, you can see the evolution of this particular slope. Beginning in January 2021, we had a significant bear steepening of the curve, which means the long end of the curve, the yields were rising while the short end of the curve was staying stable. So you had this nice run up in the slope. You got to a high of like 150 basis points, all the way down to negative 41 basis points. Now, the calculation I did on the previous screen uses data from treasury.gov, which keeps the yield to 2 decimal places. So I had negative 40 as the inversion on the curve. Here we have negative 418, 2 extra decimal places that I don't have, and that's because this service is using all the decimal places. So if the 10 had extra decimal places than the 2, by the time you subtract them, you don't quite get 40. You get something a little different than 40. What do we have down here? Here's the US, here's Canada, Germany, we have France, Italy, Japan, Australia, China, and India. And where we have a negative sign means we have an inversion. Notice that India, China, Australia, Japan, France, Germany have no inversions. If there's nothing here, it means there's no security matching that would match this pair. One of the 2 securities are missing. Look at Canada. Canada is inverted all the way along the curve. So the Canadian market is basically pricing in an absolute guaranteed recession, saying, well, it's going to happen. It's just going to happen. No discrepancy there. And look at the 10 versus 2, 66.7, way ahead of the U.S. U.S. still has some positive slopes, but we do have inversion where it matters. You have the 10-year to the 2-year being inverted, which is the key one to look at. The 10-year to the 5 years inverted. In fact, if you go to the 10 to the 1 year, it's inverted. The 1 to the 2 is inverted. What is the 1 year? The 1 year is at 3.56. The 2 years at 3.07. Oh, sorry, 3.96 on the 1 year, 3.85 on the 2 year. So the 1 to the 10 is now inverted as well, which isn't here because that's mixing a money market with a capital market security. And we can add other slopes if we want. We have other countries that we can add. Australia, we can see down here. We can add any particular one for Australia. We can look at the 10 and 2 in Australia versus the US 10 and 2 over that period of time. We can look at it year to date. It's following along, but it's not inverted. This little dotted line is your 0, but it is heading down towards inversion, whereas the US is already inverted. We have Brazil, Canada, there's China, France, Germany, India, Italy, Japan, Portugal, Russia, South Africa, South Korea, United Kingdom, United States. This is not interactive brokers. I'm in the applied series. I'm moving on to the macro series in about a month. I'm just finishing up the 6 initial sector analysis. 3 are up right now. One of the financials will be up this week, and then there's 2 more to go. All of them will be filled in, by the way. There's 6 of them are done. All 11 will be done. I just need authors for the other ones because some of the other sectors, I don't really know that much about. So it's better to find somebody who has been working in that sector for 10 years, and say, listen, you want a writing contract? Why don't you write something up for me? So those will be up in time. In fact, it'll not just be the sectors, the industry groups, the industries and the sub-industries. All of them will have videos describing what drives those particular sectors. When I move on to intermarket analysis, interactive brokers just doesn't have the charting and the data that I need. I can't get certain types of charts. Like ratio charts, and those are very important to have. And there's a limit to how much its charting function can do because it's not set up for a lot of that kind of stuff. So you have to find a data provider who has real live market data, not something that's 20 minutes old or 2 weeks old or with a delay. It has to be the most current data across all markets if you want to do intermarket analysis. So I had to use a different provider to get this one done. There is a link in the description box for this particular provider. And when I spoke with the provider, I said, look, I could bring you some business, but you got to do something for them. They will offer a discount. And I looked at a whole bunch of different ones in terms of their functionality, what they had, and their price. I started with Y charts because it seemed to be the most common name that I've heard. Unfortunately, they're $3,600 a year. $3,600 a year. I thought, there's no way I can recommend that. Not to a retail investor. There's absolutely no way. So that was the end of that conversation. There was no discount they could give that would make any sense on $3,600 a year, and that's for the low-end stuff. I found this provider, which has basically the same stuff. For a tenth the price. $360 a year. And I think the discount we negotiated was 10% off. And I think if you pay for a year, it's $30 a month, but there's a lower price if you pay for a year, and then you get 10% off of that if you like what you see. I will be using this more and more often because it is more powerful than what I have on Interactive Brokers as far as generating different charts from different markets. So the link is in the description box if you're interested in having a look at this one. Let's have a look at corporate credit. And what you see along the bottom here is mostly U.S. None of this should be a shock. All of it is negative. And if you have been through the fixed income sections in the CFA curriculum, none of this should be a surprise to you either. High duration, low duration. Look at the differences, right? 15 years plus, well, it's got high duration, so it's down the most. 1 to 3 years, very low duration. Rates are still up, so it does still have some duration, so it's down, but not down as much as the higher duration. And again, this here shouldn't be a surprise to you as well on the ratings. And here's our high yield. We can look at other markets as well. We have U.S. corporate high grade. We have it by ratings as well. High yield, European corporate high yield. Here's emerging markets. So you have a bunch of different indices here for emerging market. And this is rather interesting down here. Emerging market debt that is denominated in U.S. dollars. And if you scroll this out, you can see the one-day change versus the one-year change in both basis points and in percentage terms across all of them. So it gives you a nice broad view of all the different markets. So if there is a particular market that you are interested in, because I focus mostly on the U.S. market, but if you want very particular markets, you can do the same analysis I do by getting the data from the particular market that you need. Now this one here is a little bit more precise. If we go down to the high yield, the OAS is 477 basis points. Look at the first screen. The OAS for high yield that I put on my spreadsheet was 4.77 as well. Because I use Fred data for this, and it preserves decimal places, much like this has decimal places. So it's more exact because the source that I use doesn't truncate the decimal places. 317 basis points OAS on the double B. Same thing I got, 3.17. I don't track B, but it gives you B. And then triple C is 11.64. It's exactly what I had on my spreadsheet, 11.64. So that's the power of the decimal places, right? Okay, we'll come back to this when we look at factors. Because we're going to look at what factors have outperformed for the year in terms of equity markets, and that if we are going to step in on any sell-off, what types of stocks would we be looking for? In other words, what types of factors would we want to buy, and on any rallies, what type of factors would we want to sell? Let's have a look at our real yields. All of them hit year-to-date highs. On Friday, on September 16th. All of them closed at year-to-date highs. All over 100 basis points as well. And with the fixed income market really accepting the higher for longer stance of the Fed, and the equity market not quite accepting it, something's going to have to give. You have a Fed saying this is what we're doing. You have the fixed income market mostly saying we believe that's what you're doing, and you still have some pockets of the equity market saying, we don't believe you. We believe that you believe that, but we also believe that things will get so bad that you'll have to pivot. Well, with the higher for longer, if you're not accepting that, then the market is overvalued, because this should lead to higher cost of capital. If the economy is going to deteriorate so badly that it's going to force the Fed, with the language that they're using, to actually pause and pivot, well, then earnings expectations have to come down. Valuations are too high. No matter which route I take, valuations are too high. So we'll visit that. And I think it's worth looking at margins, because we have earnings season coming up, and sort of giving our best guess as to where margins are going to go. Break-even rates all negative. That is consistent with higher real rates, higher nominal rates. Is that it should work on inflation. So our expectation of inflation into the future should be inversely related to the level of the yields. Higher yields, okay, you're going to beat inflation down. I expect it to come down. So that is consistent. It's also consistent with the Fed having credibility. If the Fed didn't have credibility, you wouldn't have the consistency in this. So it's nice to see that. Mortgage rates. Another big story here. Year-to-date highs. Year-to-date highs last week. And on Friday. This is the closing of Friday. Year-to-date highs, except the last one here. 6.35 on a 30-year fixed. Last week was 5.97. So 38 basis point move in 1 week. For FHA, 5.75 was 5.38 last week. 37 basis points. In a week. So both of them move pretty much the same amount. We're not going to see that in mortgage applications till next week, because this is the data ending for September 9th, down 1.2%. I mean, that's not surprising anymore, right? The refi being negative, that's hardly surprising as well. I can't see how it would be anything but negative next week, since we're sitting at 635. Purchase index 1.5. Positive 1.5. If we look at Realtor.com, week ending September 10, 2022, this is median listing prices, 11.7%. That is for the week ending September 10th over last year. But before we get too excited about this, let's find out if there is a seasonal pattern to these sorts of things. And we're going to see that there is a very sawtooth seasonal pattern to this, that this may be nothing more than the reflection of a seasonal pattern. New listings lower, negative 13%. Active listings still the same as last week, pretty much across the board. Here we're 6 days slower, so it is taking more time to sell for the same week over last year. But year to date, it's still moving faster. You still have a fairly decent housing market, as far as them moving faster, year to date faster. This year, 11.7, that's 39 weeks in a row of double-digit growth, week over week, for the week, the comparable week year over year, I should say. But this 11.7 is the lowest year over year weekly comparison since January of 2022. Let's take a closer look, or a little bit of a deeper look, at the housing market. Okay, what are we looking at here? This is the S&P Case-Shiller U.S. National Home Price Index, and this is from 2012 to 2022. And whenever you see a pattern that looks like this, that is seasonality. So to check, I looked at what month the peak happened in. April. Look at that. The peak happens in April. After the pandemic, you had an October peak and a March peak over here. And I look at where it troughed out here: October, November, October, January, October, October, January, January, October. January is usually considered the lowest month of the year. and then it rises from there. And the increase in home prices follows along because it is the buying season, so there is far more demand in the spring than there is in the fall because people don't really feel like moving in the fall. They don't feel like moving before Christmas time, before New Year's, and since it's not a heavy traffic season, you're not going to get the best viewings that if you could simply wait 3 or 4 months till March or April, you'll get better pricing. So that's what most people do. So supply tends to concentrate where demand tends to concentrate, which is in the spring. So if you're listed your home and it's not selling by the time you get to September, October, you're probably willing to accept, offers that are coming in below your asking price, because if you got to sell it, well, you got to sell it, and that's the season you've chosen to sell it in. So we do have seasonality. So when we saw on the previous screen, 11.7% for the same week year over year, could it be that there is some seasonal, something seasonal at play? It could be. But it does control for year over year. So being that it is September, if we draw a line through, if this is October, if we draw a line through all the Septembers, it should be comparable. But there is some seasonality. So is it heightened seasonality that we're seeing now, or is it really something in terms of what we can expect for more downside on pricing? I don't know. I don't think so. So what I did is I extended it out further and I looked at other recessions. This is 1990. This was a savings and loan crisis, so it did have some effect on the availability of credit. Housing prices really didn't fall that much, nor for that long. This is the 2000 recession. Again, other than normal seasonality and maybe a little bit of extended seasonality here, they never turned negative. So we didn't have any negative month-over-month increases in the housing price index. This is ugly, and this is what is in everybody's mind is, are we looking for another one of these? Well, this was the result of a significant amount of oversupply. We have right now a significant undersupply of homes. This was also due to a very highly leveraged home. In other words, you had houses being sold with no down payments, interest-only payments, low initial loans. Like a lot of this stuff was going on. So if you took all of the homes in the U.S. and you eliminated all of the homes that had no mortgage, in other words, they were fully paid off because, well, nothing can happen to those. They cannot end up in foreclosure because nothing is owed on them. And you just took all of the homes with mortgages and you looked at the equity, it was significantly lower than the equity today, meaning that you had much higher housing leverage in the system. You had much higher banking leverage in the system as well, and you had mortgage fraud galore. You don't have any of that today. In fact, after the GFC, which we call this a great financial crisis now, after the GFC, capital adequacy requirements for banks strengthened considerably. So they had to be concerned about who they were giving loans to, the riskiness of the loans themselves. The credit quality of the borrower increased significantly. The amount of equity in the homes increased dramatically, and you had a nice run-up in price over here that has not come out of housing as of right now. So if you bought a house 2 years ago, even though prices may have pulled back 10, maybe even 20% in your region, you still have positive equity. So I don't think you're going to get this. If anything, I think it'll look more like this. So I'm not anticipating that there's a lot of downside in housing prices. I think if you see housing prices sometime in October, November, I think you'll see the bottom of housing prices for this particular cycle, because this is what happens next. Now, you may say, but mortgage rates, we're at 6.35% on a mortgage rate, and that might go, if the Fed moves another 100 basis points, maybe you'll go to 7%. 7% will kill the mortgage market. October 93, mortgage rates were 6.86%. This should be 97 over here. December 97, mortgage rates were 9.25%. In October of 98, it fell back down to 6.73. Didn't drop below 5% for the first time until here. Until January of 09, the 30-year fixed mortgage dropped below 5% for the first time in this particular series. For the first time. Back here, the 30-year was over 10%. And you still had housing gains of 1% month over month. Look at that. There's up to April. You still had those gains. It was below 5% for the first time down here. Now, this should have led to a housing boom, but it didn't in terms of supply. So since supply could not keep up, prices boomed, and that was the result of having that less than 5%. So you do have higher mortgage rates, but not so high as to say we've never seen this before. Yes, we have. All through the 90s, we saw that. This over here is the increase in housing prices year over year between certain dates. So after this recession, housing kind of was in the doldrums for about 6-7 years. So from March of 91 to January of 97, the index went from 75 to 83, which is about 2.25% per year. But then up to 2006, from January, the beginning of 97 to mid 2006, housing prices increased at a rate of about 8.7% per year, with significant building, a lot of building, to the point of oversupply. And then from mid-June, about June 2006 to January 2012, that's where you had your price declines. It declined by about 5.6% per year. And then after that, you just had upward gains, because after we came out of that, it didn't take long before you realize that, wait a minute, we don't have enough houses on the market. And then, housing prices were increasing well into 2019, 2020. They were increasing at a ridiculous clip per year. 15, 20% in some markets. You didn't need the pandemic to get 20%, 30% year over year increases. It really juiced the returns, and I think that's coming out. So in terms of, well, what do we expect on the downside? I don't see this happening. If anything, I think it's going to look more like this. Okay, here's a different way to look at the housing market. This is the median sales price of houses sold in the U.S. divided by the median household income. So it's how many years of your median income would it take if 100% of it went to the purchase price of the house. In 1990, we have 4 times, but in 1990, the 30-year was at 10.25. And just to give you an idea of what interest rates, mortgage rates look like over this period of time, here are the mortgage rates, the average for the year from 91 through 99. Look at where they are. We're at 6.35 right now, and saying, "Oh my God, that's gonna destroy things." It didn't destroy the housing market. It didn't do this. It just went sideways. If you look at the previous screen, we saw that housing prices still increased by 2.25% per year during that period of time where it was considered kind of a stagnant housing market. They still increased in price. This is 1999, and this is the big acceleration here. This is 4. You could draw a straight line through here at 4. Peaked at 5.1 times the median household income. The median housing price was 5.1 times. The 30-year mortgage at that time was 5.87. We're at 6.35. We were at 5.87 last week. It's pretty much where we were. This is 5.04% on a mortgage. We got the 5.32 times income up to 5.6. This was January 2021. The 30-year was 2.96. So when we look at the difference between this, it took 4 years of your income, sure, but mortgage was 10.25%. Here it's only taking 1.6 times more, 1.6 years more, 5.6 times your income. Mortgage rates are 2.96 at that time. This was Q1 of 2021. So what does this mean? 5.6 times your income. Well, that would mean a $560,000 price if you had a $100,000 income. That's how you get to 5.6. These are just hypothetical numbers, but that still gets us to 5.6. So if you put 10% down on a 30-year at 2.96, your payment was $21.14 per month, which was 25.3% of your income. Under 30% of your income, because you should be under 30% of your income in terms of your housing. Well, this was Q1 2021, so I adjusted both the price and the income for the increase in the housing price index from this point of time to Q2 of 2022, and I adjusted the average income as well for the rise in incomes over that period of time. So that means we would be at 666, 760 on the price for an income of 116,240. That is 5.73 times your income. So instead of 5.6, now it's 5.73. Using this price here, 10% down, 30-year, and using 6.3 as your mortgage rate, you'd be paying $31,1962 per month. The danger, and I think what causes most people to think, oh, well, there's going to be a housing crash, is to say, well, your payments are going from $21.14 to $31.19. That's going to cause a crash. Yeah, but your incomes went from 100 to 116. So it's only 32.2% of your income. Yes, it's more expensive, but it's not like we're saying, well, this is $1,000 a month, it's $12,000. That's 12% of your income higher that has to go to it. No, it's not. It's about 7% more of your income that has to go to the purchase of your home. And this is for a new buyer. This is for a new buyer today who's going to buy at 6.3%. Well, 32% is still not unrealistic if we think, well, you should be somewhere around 30% of your income. The median is sitting at 32.2. Yes, it was at 25.3, but that was historically low. 32.2. That's not unrealistic. And 5.7 times your income, I don't think is unrealistic, given that rates are 6.35 and not 10.25. Now, if mortgage rates climb to 7, then they climb to 8, then they climb to 9. Once we start getting here, then I would revisit this, and I would say, well, now that's going to cause a problem. That has to weigh on housing prices. It has to weigh on housing prices if you keep raising rates like that. The problem is we have a shortage. So being that we have a lack of supply, there's only so much you can do unless you completely destroy demand. But where are all those people going to go? Right? Apartment vacancy rates are low. There's not enough space for them to go to. So I don't know that they have a choice, that the buyers really have much of a choice, being that you have such a constrained market. And this is not unrealistic. 5.6, 5.73. That's not really unrealistic overall, when you think that the cost of an education and the annual salary you would get, sometimes if you took your entire salary and put it towards your student loan, and we're just qualifying it based on median, based on averages, you're somewhere around 2 to 2.5 years for an education. Here, you're buying an asset that even in a dull market increased by 2.25% on average per year. So you're buying an appreciating asset. So if we look at it in that context, I don't know that you're going to get big crashes in housing prices. I think that by the time we get to the fall, combine it with the mortgage rate in context, combine it with the fact that we have a shortage and that there is a seasonal factor to this, I seem to think that we would see the bottom of housing prices November, December, maybe into January, but from then on up it goes. Just the way I'm seeing it from looking at all of this. All right, we have earnings season coming up. I know that the next big event is the Fed on Wednesday, and I've already talked about that, of what we can expect, 75 or 100. Time to look past that. The next big economic report is the PCE at the end of September, which is the expenditure side of CPI. CPI is the prices charged. PCE represents what people buy. I don't expect that we'll get any kind of different information other than what we got in CPI. PCE tends to come in lower than CPI because PCE does shop around and does substitute. But I think it would be consistent with CPI in that the PCE for September will be higher than what we saw when we got the report in August. I should say the PCI in September for August will be higher than we got in August for July. So let's turn our attention to earnings. And on the screen, this is corporate profits after tax divided by gross domestic profit. So national income has a bunch of components. There is wages, rents, there's dividend and interest income, which is return on capital, and rents and dividends and interest are all return on capital. And then there are corporate profits, and each one has a certain share of GDP. And corporate profits after tax right now are sitting at about 12.1% of GDP, a series high, by the way. This is for Q2 of 2022 because we don't have Q3 in yet. That is a series high. It was mean reverting for a long period of time. So I did some time series regressions on here to find mean reverting levels for different periods of time. Here's the full series. If I took all of the data from this point in time all the way to this point in time, the full series, the mean reverting level is 0.07513. And how we get that is it's just an AR1 model, right? Autoregressive is we take YT and we regress it on YT minus 1. And our intercept is not significant, but our coefficient is significant. It is different than 1. So we find our mean reverting level, B0 over 1 minus B1, 0.07513 is the mean reverting level. We are way above the mean reverting level. However, we're going to break this down into two regimes, pre and post. Over here at this point in time, this is China into the World Trade Organization. And being that China is in the World Trade Organization at this point in time, suddenly businesses have access to a much lower cost structure than they had without China because wages were super cheap. You can outsource a bunch of stuff to China that wasn't critical, like assembly or production of certain components or input components, and you could boost your margins. You didn't have to lower your prices. You could actually continue to raise your prices and lower your costs at the same time. So you had this nice hit up here. You had this nice hit to margins, which showed up in a significantly different time series than pre. So I broke it down into pre because it was always believed that a mean reverting level was about 6%, and this is 5.9%, which is very close to that 6%. If I cleaned up the data and spent a little bit more time with it, I might have gotten to 6%, but I did it very quickly. I'm in the neighborhood, I'm close enough. This is ending in Q4 2001. China entered WTO December 11th, 2001. It's not just China, by the way, it's China and India that came into the World Trade Organization. And then if I just take the post period, just this period here, the mean reverting level is 9.97, just under 10%. Well, we're above the mean reverting level on no matter how you measure it. 12.1 is way above 6%. For the full series, it is way above 7.5%. And if we just count the post-entry period, 10%. We're at 12.1%. And when we look at our significance for our coefficients for the two series separated as opposed to the full series, everything is significant. everything is significant, and everything is significantly different than one. So this is significantly different than one, and this is significantly different than one, and it would have to be to have meaning, otherwise you'd have no mean reverting level. And this series does have a mean reverting level. So, which one do you believe? Do you think that, well, this was a one-time hit and we're not going to get that again? However, it may not go away, so let's stick with 10% as the mean reverting level now. You could say, well, hang on a second, this was a lot of globalization. We are now getting a lot of localization. We have jobs coming back. And if this was jobs going to low-cost areas, then jobs leaving low-cost areas coming back to high-cost areas would say, okay, well, then this is off the table. Maybe we're going back to here. Or, more than likely, going back to some mix of the two, because we're not completely going to leave here, and we're not going to completely come back here, but there'll be some kind of tapered strategy between the two. The only way that you could argue that we can make the mean reverting level higher over time is if you think that we can repeat all of the tailwinds we had for the last 20 years. What's the next globalization step? There's Vietnam, which has lower labor costs than China. There's Mexico, which has lower labor costs than China, but they don't have the same market size as China in terms of the sheer number of people. Plus, there's already been a whole bunch of foreign direct investment in China that doesn't exist in Mexico yet or doesn't exist in Vietnam. So there's a whole bunch of capital expenditure that has to be made. Even localizing stuff requires CapEx. Well, CapEx has a cost of capital. You didn't have that in China, so that was in this increase as well. And now we're seeing increase in wages coming down here. And that labor wants a larger share of the national income. So from where I'm looking at this, I can't see how we can maintain this if we are going to reverse globalization into localization, which we're already seeing. We're already seeing that unions are gaining more and more power in North America. Wages are going up across the board. California has raised wages to, $22 an hour for service workers in fast food restaurants. The settlement for the railroad workers last week, I think, had a 15%, a 14 or 15% wage increase, and there's even concern that the membership might not even vote for that. However, to be fair, it sounds like a lot, but to be fair, for the last 3 years, they had no wage increase. So this is like 3 years all in one, so it's like 5% per year. Doesn't sound so great when you look at where inflation is. Maybe they're not going to be too happy with that, so we don't even know if that's over. Next year, you have the auto workers union. What do you think they're going to do? They don't have a history of being nice. When they go into that negotiating room, it's knives out to the throat of management. And it is, you do what we say or we will slit your corporate throats. We'll shut you down. We will shut you down. And they're perfectly willing to do that. They did it last time. So I think that they're going to be far more aggressive. I don't see how those margins can hold given the reversal of some of the things that are happening. Low wage components of corporate income statements are shifting to higher wage. The lack of CapEx, relying on a build out by Chinese firms to build out their infrastructure and simply just sending work to them. Well, now you got to build your infrastructure. Now you got to build your battery plants over here. Now you got to build your facilities over here, which require CapEx, which requires capital, and capital has a cost. So we're going to look at the next 4 quarters earnings forecast, or what the consensus is for earnings. I seem to think that this next earnings report, I think Q3 earnings are going to be okay because we're in a slowdown, but we're not in a contraction, which means they'll still be growing. Earnings will still be growing, maybe at a slower rate, but they'll still be growing because we had employment still growing. And if you have employment still growing, aggregate incomes are still growing, assuming a constant marginal propensity to consume. That money is spent in the malls. And while I was doing this yesterday, I thought, that's an interesting thing. got in my truck and I thought, let me just drive past the mall. So I went to the mall and I drove around the parking lot, and you had to go way to the back where nobody goes, way to the back to get a parking spot. The mall was full, and I don't go into places like that. On a Saturday, you don't go anywhere near a Costco. You don't go anywhere near a Costco or a Walmart. You drive around and you look at all the places, all the malls and the big box stores, and you think, okay, I just don't see a recession here. I don't see any slowdown in spending. So I think Q3 earnings are going to be okay. It's the guidance that's going to be important. And what did we see last week? What caused some pain in the market last week into the end of the week? FedEx, and we get earnings from FedEx this week. That's why they warned a little early. And we also see Costco this week, so we'll see what they have to say. Okay, let's just dive into margins just a little bit more. We're going to compare two types of variable costs. In a very simple way, here's a company income statement. You have revenues minus their fixed costs, minus their variable costs to get to operating income, which is EBIT. Subtract out your interest, subtract out your taxes, you get to net income. And revenue growth is going to be the thing to look at in Q3, and revenue growth over the next year. I think with inflation as high as it is, we have to look at revenue growth in terms of real numbers. So whatever projection we get for revenue growth, we should adjust it for inflation to see if there is real revenue growth, which means there's quantity growth. There's more stuff being sold as opposed to less stuff being sold at a higher price, because you can always get revenues up that way. Your fixed costs are a function of your asset intensity. So you have some businesses that are highly asset intensive, some that are called asset light. When you have a high level of asset intensity, you have high operating leverage, meaning that if, let's say you have an operating leverage of 3, meaning if revenues go up 2%, your operating income goes up 6%. So it really boosts your income at lower levels. However, when sales drop, you have rapid margin compression, because if sales drop 2%, your operating income drops 6%. And you tend to have low variable costs. So there's not much you can do in terms of adjusting your variable costs, because most of your business model is based on fixed costs. When you have a low level of asset intensity or an asset light business, as most software companies do, you have very low operating leverage. So, if you have a 2% increase in sales, you might basically just get a 2% increase in operating margins. You have high variable costs, so you have a lot more ability to adjust your cost structure to changing conditions by adjusting your variable costs. So let's look at variable costs. There are two broad types. They can either be a linear function of revenue or a stepwise function of revenue. So think of cost of goods sold. Let's take a grocery store that sells $1 million per week. And let's drop revenues 2%. So it's selling $980,000 for the week instead. So it's $20,000 less. Well, if it's not selling $20,000 a product, its variable cost should decrease linearly with revenue. There should be a fairly good relationship between revenue and those type of variable costs if they have a linear function. You have some other variable costs that have a stepwise function of revenue. That the drop from $1 million to $980,000 for the grocery store might be small enough, it's 2%, but it might be small enough that the store manager says, I still can't spare any labor anywhere. It's not a big enough drop for me to try to get rid of 2% of my labor force. I can't get rid of 2% of my labor force from this. I would need a bigger drop in revenues to get that. So as revenues are dropping, these variable costs are not. So it's here where you get margin compression, where you have a drop in revenue, but your stepwise marginal costs can't drop. And then when you get to a certain point, then it drops considerably. Well, the only way that these stepwise ones drop, and I say the only way, the biggest way is labor. So the key indicator that we're going to keep our eye on going forward is employment, and a particular component of employment. So job losses. if you have job losses. Right now we have job gains. You see the jobs report every month, we have job gains. If you have job gains, that's greater aggregate incomes. That means more money being spent. That supports revenues and supports revenue growth. If you have job losses, you have lower aggregate incomes. That means there's less money being spent, so you are going to get these drops in revenues. What we want to keep our eye out on is initial jobless claims. And the key level to watch for is the 300,000 per week level. Once we start seeing initial jobless claims over 300,000 a week, you're going to start to see job losses on the labor reports. Because right now we're running about 200, 225 a week. So if you go to 300, there's roughly about 75 times 4, 300 to 320,000 extra jobs that are lost over the course of the month, and that's pretty much what the economy is creating right now. That's where you would get to the beginning of job losses, and if we have job losses, you have to conclude that you're going to have shrinking revenues. And that is assuming that the marginal propensity to consume doesn't drop with job losses. In other words, those that don't lose their jobs, instead of spending 97 cents of every dollar they make, they start spending 95 cents of every dollar they make. The higher bond yields go, the more money is drawn into that, the lower the propensity to consume, the higher the propensity to save. So higher bond yields will, at the margin, compete with consumption. And if we see this level breached for a period of time, I think that would be a big signal that layoffs are going to exceed hiring gains, which means you'll have job losses. And if you have job losses, you have drops in revenue. If you have drops in revenue, you might get to one of these step functions where that creates more job losses, because that becomes self-fulfilling. Executives start to see that kind of thing. They say, well, rather than wait, why not lay off now, because we anticipate revenues to drop, rather than revenues dropping to the point where we can step down on our marginal cost. Let's just do it now and we'll just make do, right? The other way of thinking of this, and I don't know which way we're going to go, that's why I say this is the key level to look at. This is the a big indicator right now, is you could argue that, listen, the participation rate is low. It took companies a long time to find their talent and to find key people, because you just can't find good people. That even in a recession, I'm not laying anybody off because I'm not going to get them back. I'm not laying anybody off. So you might have labor hoarding and companies willing to take lower margins because of labor hoarding. No matter which way I look at it, I see lower margins ahead. I don't know that we can maintain this 12% net income margin as a proportion of GDP going forward. So we're going to add this new indicator onto the things that we watch each week. We look at rates, we look at the housing market, mortgage levels, we look at CPI, what the Fed is going to do. But now I think if we're looking at how margins are going to evolve, are companies going to lay off to preserve margins, or are they going to hoard labor to preserve their workforce? I don't know. This will tell me, so we'll keep an eye on that. All right, here's our SPY, our ETF that tracks the index for S&P 500. Next 12 months, consensus 232.35. That is Refinitiv data. And that is for Q3 of 2022 to Q2 of 2023. Once we start earnings here, this will drop off. So that after the first set of companies start reporting in October, this is gone. The next 12 months will have Q3 2023. And it may be lower, depending on what the guidance is going to be. We will see. Earnings for this week, we have Lennar and General Mills. Lennar is after the bell, General Mills is before. They're both expected to beat. One is consumer staples, one is consumer discretionary. This is housing. I'm going to be listening in on this conference call. I'm interested to see what they have to say about the state of the market and what their guidance is going forward. I think guidance is going to be big there. Thursday, FedEx. Did they overwarn just to get a bounce? Companies do that. Did they come out and say something and make it seem worse than what it really is, so that when they do report earnings and they do have their conference call, they'll lighten up a little bit on it? I don't know. But FedEx is after the bell. Costco is after the bell. Costco is a lot more a lot more recessionary protected than things like Target and Walmart. Costco carries far fewer items in inventory. They have membership fees, and they don't lose money. In other words, they have a markup on everything. They can have a very low markup. I think their maximum markup is like 13 or 14%, and that's it. So they are much more recession proof. So I don't anticipate bad news or bad warnings out of Costco. Then you have Carnival Cruise Lines. This is before the bell. I stick it in here because their guidance, I think, is going to be really important. Okay, where are we? 38.73. We broke 3,900. And I seem to think that, if we bounce between 3,800 and 4,000, more like 38.50 and 39.50, in between here, I got a big question mark. I don't know what to do. I'm neither a buyer nor a seller. As we head on down, I do look at buying things, and as we head on up, I do look at selling things. But right now we're at 16.67 times earnings that many people are starting to say now have to come down. That 232, that's just not going to happen. You have higher interest rates, you have higher wage rates, inflation doesn't seem to be abating, and you have the potential of a slowdown, not just a slowdown in North America, but a recession in Europe, a potential recession in China. Those numbers got to come down. There's a lot of good reasons why they got to come down, and they really haven't budged too much. So I think this earnings season is going to be a big test for that. But we're at 16.67. Most recessions don't have long-term multiples. This is in line with the long-term multiple, the median 10-year multiple, let's say. That's in line with the median 10-year. But most recessions don't have median multiples. So you have expansions and contractions, expansions, contractions, and there's your median multiple there. So we're here. And if we're going down here, you could go to 15, even 14 times. 15 or 14 times a lower number, because in a contraction you would have a lower number. There is a very real possibility that we could drift lower over time. Possibility. But for where I stand right now, I don't have enough information. I have to see earnings. Implied volatility percentile on the S&P 500, which is rather surprising to me given what we've had at the tail end of our chart over here. If we're looking at the 13-week implied volatility percentile, we're only at 71%. For 26 weeks, 63, and 52 weeks, 73%. I thought they would be higher than that, but they're not. So the sell-off appears to be orderly, and I think there's a belief that we're going to be supported at the lower price. That we're not going to breach the lower prices here. So with these, I'm selling premium doesn't really. I don't know. It just seems rather low to me at this point. So what I'm doing now is pretty much the same thing I've always been doing. If we start pushing downwards to 3,800 and below 3,800, any short positions I have, any negative dollar delta beta, I will close for my gain, and I'll look to add dollar delta beta with particular factor exposures. Here I'm looking for dividend, I'm looking for quality, and I'm looking for value. Anything in these particular, anything that has those factor exposures, I'm willing to add those as my long positions, because until the Fed signals that it is near the end of its rate hike cycle, so it can pause. It can stay paused for a year, and the markets can adapt to that. That's not a big deal. It's not that higher is going to hurt us, or sorry, it's not that longer is going to hurt us. It's how high are we going to go before we go sideways. Once they start signaling the end of that, and we can see that in sight, then you want to start rotating into things like growth and momentum. So we're going to look at some factor returns year to date, and we're going to see which has been performing the best year to date. And it should be no surprise that growth and momentum and small cap have been the worst performers. Coming out of this, they will be the best performers. So it's a matter of, well, when are we coming out of this? Not now. Not now. Not while we're in a tightening cycle. We have to see the second derivative, the slowdown of the tightening cycle, the end of the tightening cycle. Listen, we can go sideways for a year. The market will adapt to that, because what comes after that, especially if inflation is coming down, and it will slowly, but it will, then we can start thinking of rate cuts, but I don't think we're going back to the zero line. The zero line was a temporary place to be. I don't think we're going back to the zero line. Okay, let's look at some factors here. This is a ratio chart. A ratio meaning that I've taken one ticker and divided by SPY, one ETF divided by SPI. Or SPY. So the direction tells me the performance of one relative to the other. It does not tell me if the price went up or the price went down. So if you look at these, these are really relative trades. So for instance, the first one here, up. This is year to date, up 14%. That does not mean that ETF is up 14%. It means if you had gone long that ETF and short the market, you would be up 14%. It's a relative trade. So it's a long-short setup. In other words, this ETF outperformed the market by 13, almost 14%. What is the next factor? Next factor here is value, outperformed by 8.7%. Our next factor here is low volatility. What's the worst performing one? Growth, followed by momentum. Well, that should not be surprising. These tend to be high valuation, high beta stocks, whereas these are lower valuation, lower beta stocks up here. So if we're looking at, if we want to add some positive exposure to the market, let's make sure the exposure we add has these factor exposures. So in other words, I'm not going to go into last year's winners. I'm not going to buy these momentum stocks and these growth stocks if I expect more downside. If I want to add, as the market is dropping, I'm going to add high dividend, low volatility, and value, which usually you find in consumer staples or you find in real estate. And with real estate being with the housing market where it is, I just can't see why apartment buildings won't continue to perform. Another safe place to be is insurance. Now, insurance does have an exposure to GDP growth. However, it is low beta, high dividend. So it is an income place to be. That does not mean it won't go down in value. It's just it won't go down by as much as the market. So if you have a short position on the market and a long position you have three ETFs here, the VYM, the IWD, and the USMV. If you have long positions in those and you balance your dollar delta beta so that you're neutral, then you should outperform the market or continue to outperform the market if the market is weak. You have other factors down here. You can see in green which ones have outperformed. You can see in red which ones have underperformed the market. And you can choose which ones you want here. So down here you have large cap value, large cap growth, your mid caps, and your small cap. You have core as well. So you can do a lot of analysis to see which one has performed better. So and you can take different regimes as well. This is the year to date. If you look at a longer period, like 3 years, it shouldn't be any surprise growth because growth really was the winner over a longer period of time. So you could also argue that, look, if I just stay in one, I'll just stay in one that was the winner for the longest time. We go back 5 years, growth always wins in the long term. There's 10 years, growth still always wins. That if 10 years ago I did that, growth would win. But if you know when to rotate out of growth into other things, year to date, look at this, you underperform the market by almost 9%, whereas this factor outperformed the market by almost 14%. So rotating in and out of factor exposures does matter, and we can get that if we understand the sectors of the economy. Some sectors are driven by very specific factors. For example, consumer staples is driven by those three factors: high dividend, value, and low volatility. Now, the ETF for consumer staples has sold off, but not nearly as much as the market has sold off. So if you're short the market and you're long consumer staples, you've won, because you're playing the spread between the two. And consumer staples has all three of these factors: has dividends, has value, and has low volatility. Okay, I'll end this week with just a quick tour of what this charting site can do. Up here I have world equity indices, so at a glance you can see which ones are performing well, which ones are not. This is the 1 year. We can look year to date. There are some that are still performing, that still have positive performance year to date. What we have on the screen here is Dow Jones, S&P, and NASDAQ. And we can see down here, NASDAQ is performing the worst. It gives you the year-to-date performance as well. S&P is down 18.73, almost back in bear market territory. NASDAQ is in bear market territory, but the Dow, which I don't think anybody really cares about, isn't. You have a bunch of indices down here as well. You have your sectors, and which is what the Applied series is working on now. So you have all of your sectors at a glance. Does that surprise anyone? Look at the outperformance of energy on that one. What is the next one that we see? Utilities. Utilities are nice because they are high dividend, low volatility, and value oriented. And then you have XLP, which is consumer staples. So if we go all the way to the bottom, we have communications. We should have consumer discretionary down here somewhere. There it is, XLY. Countries. If you want to get a broad look at different countries, you can see all the different countries, and there's a ticker, an ETF ticker for each of these particular countries. We've already done factor analysis, global yields. If you want to just look at a glance, say, who's got the best 2 year, you could just read across here and see who has the highest 2 year. India at 6.83. Actually, if you put Mexico in there, Mexico beats that. But you have the yields for US, for Canada, Great Britain, Germany, France. Recent IPOs. This is rather an interesting screen. So you can pick on one of these IPOs, one of these dots, and you get another little window up. This is AMT Digital. It tells you how much it raised, 20.26 billion. And the percentage that it's up since its IPO. Currencies, if you're into currencies, here's a currency grid down here. You can choose whatever currency performance that you want. This is US CAD, so we see it's up 4.93. That means the US is, since it's the first of the pair, the US is up 4.93% versus the Canadian. But the US is down 2.22 against the peso. By the way, I said I would add some peso exposure. I did add peso exposure on some weakness over 20, I think at 20.13. I added some peso exposure. So I'm in on that one now. What else do we have? Commodities. You can see the performance of certain commodities. Here we have, down here, this is crude oil. This is steel. We have aluminum. You have copper. All of them are down. This is coal. Interesting, right? Coal is up, and of course, this should be no surprise. Look at nat gas, coal and natural gas. And as far as food, if you've been watching live cattle and feeder cattle, they're just on a tear. What else do we have? We have fixed income factors as well. You have more interesting information here if you want mortgage-backed securities, municipal bonds, Ginnie Mae. Here's the TIPS securities. So there's a lot of good information in this that you can get, and this is just the dashboards that I'm showing you. There's still a whole bunch more you can do with economic data. combining the fundamentals of a company with economic data, not just the price, but the fundamentals of a company with economic data. So I'm going to be using this more and more. If you are using the Applied series, if you're a subscriber to that, once we get to the top-down part, we're going to do intermarket analysis. Can't do it with Interactive Brokers. Don't have the charting and the data necessary to get it done with Interactive Brokers. We do need a particular service that gets this done. In all the ones I've looked at, this is the best one I could find. And it's inexpensive, $30 a month. If you're paying monthly. If you pay for the year, I forget what the discount is. There is a lower price if you pay for the year. And then if you use that link in the description box, you'll get another 10% off in your first year. So if you find this stuff interesting, if it's access to a lot more information than you have, or having it aggregated all in one place saves you a whole bunch of time, well, your time is worth something, right? Maybe it's worth the $30 a month. Anyways, there it is. I'll leave it with you. And that wraps it up for the week. The big event by far is Wednesday, is the 2 p.m. in the afternoon is the FOMC decision. 75 is in the books. 75 is going to happen. Get comfortable with 75. Will they go 100?